Over the last 2 years, it's pretty likely that you're in one of the millions of households that relied on Amazon deliveries. And if you spent any time binge watching shows on Netflix or Disney Plus, you were also an Amazon Web Services customer. So with so many of us using Amazon's products daily, does it make sense to buy the stock while also consuming Amazon's offerings? The answer is yes, according to my colleague Andrew Barry, who named Amazon one of his top 10 stock picks for 2022. Amazon is coming off a sluggish 2021, where shares lagged the S&P 500 by 20 percentage points. That said, even with its relative underperformance, Amazon still fared much better than other stay-at-home stocks like Zoom Video and Peloton. And even after a weak 2021, Wall Street is optimistic about Amazon going into 2022. For starters, while many companies dream of dominating in the field they're in, Amazon is top dog in two areas. It has about 40% of the e-commerce market and about half of the cloud computing sector.
You're buying a company that is the leader in two businesses, and you're buying that package for probably less than what it's worth right now. Potential catalyst could be a spin-off of Amazon Web Services. That potentially could happen in 2022. There's been talk about that. And another thing that would help it out would be a stock split. The stock trades for over $3,000 a share. It has not been split in well over a decade. And I think a stock split would also be welcomed by investors because it would potentially broaden the ownership and be a signal by the company that they feel that the stock is undervalued.
Amazon's web services business could see 20% annual revenue gains over the next 2 to 3 years and expanding margins, according to analysts. Not bad for a business that is already known for its high margins. Much has been written about megatech names passing trillion-dollar valuations, but some analysts believe that AWS alone could be worth $1 trillion. What this means is that with Amazon's market cap recently hovering around $1.7 trillion, all of its other businesses, e-commerce, Amazon Prime Video, and advertising, to name a few, are worth $700 billion. That, or Amazon stock, may be undervalued.
Amazon looks undervalued. By traditional financial measures, it doesn't look cheap at all. It trades for about 60 times 2022 earnings. That's like triple the market multiple and above the price earnings multiples on companies like Apple and Alphabet and Microsoft. But it has a very strong growth outlook, both in its cloud computing business and in its e-commerce business, plus some growing businesses like advertising and others. So it's really, there are multiple plays inside Amazon right now.
So what's next for Amazon? With Andrew Jassy, who formerly led AWS, now at the helm of the whole company, expect even greater emphasis on the cloud business. One thing to note about Amazon is that historically, it's been willing to sacrifice short-term wins to focus on long-term gains and sector dominance. So last year's sluggish year may be the beginning of something big.
They've been investing very heavily in their distribution and also their logistics business in terms of getting products to customers as quickly as possible in this country. They've been hit by higher wages and higher costs of freight and transportation. So they've been absorbing all these costs, but I think their moat or their competitive advantage keeps getting wider versus the field. And that's not been apparent in their earnings as they invest. But I think it should be more apparent in the next year or two as maybe some of these cost pressures start to subside.
In the case of Amazon, it may be worth shopping the site and shopping the stock.